Hello, my name is Rainer. I am with a group that is known as überalpha.com. We are based in Asia. We have our roots in Silicon Valley at the time when Apple Computers and other companies invented their products. Yeah. What we do is we do research on the stock market, and what we have found is a new and interesting way to look at the stock market. What we look at is something that we developed is an indicator for what we call market pressure. On a daily basis, what we find is that we can look at what has happened in the stock market, and we can determine how much up pressure is due for the next day and how much down pressure is due for the next day. So if, for example, we say the down pressure is greater than the up pressure, we might forecast for the market to be down. If we say the up pressure will be greater than the down pressure, we might forecast for the market to be up. Now, the question is if we do this, how well does it work? Number one, what percentage of the time are we correct? Yeah, and not only what percentage of the time are we correct, and what are we using as a basis? Yeah, that is a question. So what we use as a basis in this situation here, in this analysis, is what we call close to close in the Dow Jones. In other words, since we know this information near the closing price of, let's say, Monday, and we forecast for Tuesday, what percentage of the time, when we forecasted, let's say, up, the market will be up, was the market actually up a point or more the next day? And what we found was we were correct about 62% of the time, both in our real time and in our historical test combined. And we will show you those numbers in a minute. Yeah? And what we found was that it was even more significant than that, because we found that when we were correct, our average correct forecast was a gain of 62 points, and our average incorrect forecast was only 49 points. And so this was very interesting to us, and this particular technology was developed over time and was finalized during this time period here on this chart. Yeah? And so it was finalized during this time period here, and from this time period here, the 25th of May, forward, we forecasted it in real time or ahead of time, let's say. So, for example, on Monday afternoon, we would say, tomorrow the pressure for the stock market is this and this, and then we would see what would happen. So what really happened in real time when we did this in real time? Well, you can see this pretty little chart, and you can see that we started forecasting here and kept on going here. Yeah, and so, so this is the Dow Jones on a close-to-close basis, and this is what we call with a pressure of 0. 0 means very, very simply that if the up pressure is 3 and the down pressure is 2, that would be favored to the upside, and so it would say up. Yeah, and now if we change this pressure to 2, all the numbers change. Yeah. We see there's a greater sense of accuracy, but we see there were less forecasts. Huh? And the numbers, in terms when we were right, when we were wrong, stuff like that also change. So what does this mean, pressure of 2? What we look at is the ratio. So, for example, if the up pressure for tomorrow is 15 and the down pressure is 5, we would say the ratio for tomorrow is 3:1. Yeah? And 3:1, as we all know, is equal or greater than 2:1. So a pressure of 2 was used here in this situation, and we found that accurate about 64.4% of the time, and these other numbers were also interesting. Yeah, and so in theory, yeah, the raw points made, of course, everybody knows that you can't trade the actual Dow Jones index because this is only an index. Yeah, so you must use all kinds of proxies that are available. Yeah? So we did this, and then we said, well, besides the Dow Jones, what else is interesting? Well, before we get to everybody's favorites, the S&P, let's look at the FTSE. FTSE is what the English have, as they call this Dow Jones. And we see in the FTSE, let's first go to pressure of 0, and we get about 52% accurate with the average win greater than the average loss. Also a very interesting thing to look at, yeah. And so we know that this has some historical statistical accuracy. And then we change the pressure to 2. Let's see what happens in the FTSE when we change it to 2. Things get a bit better, and we see here 53%, yeah, the pressure of 2. Just for grins, let's see what happens if we change the pressure to 3. 3 goes down, 4 goes down, 5 goes down even more. Let's just really get crazy, go to 6, goes down a lot. So apparently pressure of 2 is an interesting number. Let's see what happens if we go to pressure of 1. Not a bad number, yeah. But 2 is a very good one, yeah. We find that universally we can use the number 2 in many different situations. Now we move on to the DAX. The DAX is the German Dow Jones, yeah, their version of the Dow Jones. And we see here that we are at 58%, good number. When we have 2, if we have 0, we only have 55%, but still this is pretty good for accuracy. And so we find that this here is also something that can be looked at and perhaps combined with other things that you have in order to enhance your trading model if you are looking at perhaps trading the market. So this would be something that if you are a market professional, we would work with you in terms of how to enhance your model for knowing when to buy and when to sell and things like that, yeah? So here we take a look at something else. We take a look at everybody's favorites, the S&P. Here we go, kaboing. All right, the S&P, yeah? The S&P, when we start with the pressure of 0, we get the good old number of 58%. It's pretty healthy, yeah? So the number 58%, and naturally the pluses were much better than the minuses by 1.5 to 1, or better than 1.5 to 1. And let's see what happens when we go up to the pressure of 2. We go to 60.7%, yeah? So that's, but of course there were less forecasts than when you have the minimum pressure of 2 to 1, or 1 to 2. So this also was something to look at. So if this kind of thing is of interest to you, we suggest that you contact us, staff@uberalpha.com. That's uberalpha.com. As this is a new way of looking at something to do with the markets that perhaps could dramatically impact the performance of your professionally managed fund. Yeah? Thank you very much. Goodbye.